Rating. Welcome to the Valuation Master Class case study, where you'll learn about interesting stocks and how to value them. What's interesting about SKF is that it generates the highest return on invested capital among its peers. This is Andrew Stotz of the Valuation Master Class. Let's get started. Remember, this information is for learning purposes only. This is not an investment advice or a recommendation. So what is SKF? Well, SKF is a Swedish company among the 6 largest manufacturers of bearings and seals in the world. It's in the industrials sector. So there's 3 things to know about this company. Consolidation of manufacturing site drives the margin expansion, and a high single-digit industry growth mainly is driven by Asia, and consistent value creation while peers struggle. Some key statistics to know. There's 7 analysts covering this company, and their target price is 250 Swedish kroners. That's an upside of about 14%, and they have a buy rating on the stock. PE ratio of about 14.2 times, and a dividend yield of 2.8%. My estimated value is about 265 Swedish kroners, which is an upside of 20%, so I'm more optimistic than the market. Let's talk about the breakdown of the revenue and sales of this company. First, the main product range is bearings, seals, and lubrication systems. Breakdown by customer, well, 73% of their customers are industrial companies. 27 are in automotive. About region, well, it's a very interesting split. 38% from Europe, so home country area, 30% Asia, 21% North America. This is a company that is less dependent on North America. So if you think that the things are going to slow down in North America, but they're not in Asia or Europe, then this company would be an interesting one to hold. Now, the price could turn bullish soon, but there's not a lot of support yet for volume. If I look at the share price over the past 6 months or so, or 12 months, overall, the price has stayed flat over the past year. The 50-day moving average line stayed below the 200 moving day average since the second half 2021. However, most recently, the 50-day moving average moved closer and could soon cross the 250-day moving average, which is signaling that there's good price momentum and that we could have a breakout. The volume RSI has been weak recently, which we interpret as bearish. So it's kind of a mixed bag, a little bit of good momentum in the share price, but not something that's flying. So what's the story? Consolidation of manufacturing sites drives margin expansion. Here you can see a chart that shows on the left the number of manufacturing units. There was about 170 or so manufacturing units in the company in 2013, and now that's down to about 90. And Ebit margin has been rising slightly. From 2013 it rose, and then it slightly rose, but it's been maintaining at about 12%. So since 2013, SKF has divested 74 of its manufacturing units. This equals a reduction of 44% and freed up more than 7 billion Swedish kroners. The company focused on consolidation and expansion of its primary manufacturing sites. So let's look at that EBIT margin. What you can see is stable and growing margins shows its resilience. The consolidation strategy paid off, as SKF has now the second highest operating margin among the 6 biggest manufacturers of bearings. When we say consolidation, what we're meaning is usually what's happening is the company is retreating a bit, getting rid of non-core assets and trying to consolidate into one focused entity. Overall, the 6 players make up more than 70% of the global market for manufacturing of bearings. And you can see that a few of them have been crashing down in margins. NSK, NTN, and JTE, KT have all been falling in their margins over time. It's also worth noting that SKF's margin has been the most stable among its peers also, very stable. Now, high single-digit industry growth mainly is driven by Asia. In 2020, the global bearing market was about 390 billion Swedish kroners. Asia made up about 50% of that, and 30% of that, 50% was China. In 6 years, the market value could reach 690 Swedish kroners, 690 billion, a 77% increase from 2020. That's massive. Rapid urbanization in Asia drives demand for bearings that are used in infrastructure, industrials, and automotive industries. SKF expanded its presence in China, which makes me optimistic that it can reach the 5+% EPS target that they've set. Consistent value creation while peers struggle. What I want to show is a chart of the return on invested capital, and we'll see that SKF is at the top when you look at the line of ROIC and the trend of ROIC from 2016 to 2020. Even in 2020, there was a little bit of a fall, but not by much. The rest of them have been either flat or falling. SKF has shown an impressive ROIC over the past years that has led to value creation. It generates the highest return among its closest competitors. Management objective is a 15% ROIC, and they were there in 2017, 2018, and even 2019. In 2020, they went down a bit, but I believe it could exceed this target, maybe even getting the ROIC up to 16 or 18 percentage points. Now, scan the QR code that's in this slide to go to the valuationmasterclass.com blog to download all the free case study reports for free. And keep in mind, if you're listening to this, just go to valuationmasterclass.com and go to blog. Now let's look at our FVMR scorecard for this company. The scorecard measures a stock's attractiveness relative to all other companies. Attractiveness is based on 4 elements: fundamentals, valuation, momentum, and risk. And the scale is from 1, which is best, to 10, which is worst. And here we can look at the company and see that what I'm going to look at is valuation. This is compared to against 190 non-financial companies in Sweden. And what we can see is that the PE is about 13 times, price to book about 2.3, price to sales about 1.2. So this company looks reasonably cheap, I would say, compared to the rest of the world. Recently, I created a short online course explaining my FVMR investing approach. I usually sell it for $97, but for a limited time, I'm offering it for free. Just scan that QR code there, and you can get access. Now, let's look at the forecast. Consensus sees a small upside. Now, I say there's 25, let's say there's, about 25 analysts, and the upside is about 14%. The majority of analysts issued a buy and 4 have a sell. Now, the revenue growth is what's interesting. Consensus expects 2 years of strong growth, and as far as revenue is concerned, and that makes up for 2020. But from 2023 onwards, analysts assume rather slow but steady growth. I would assume that it probably goes, right now, 2022, analysts are expecting 7%, and then in 2023, they're expecting 3%. That's a half or 50% reduction in revenue growth, probably unlikely. So I would be a little bit more optimistic with longer term revenue growth. Now let's look at the P&L of the company. Revenue could return to the pre-pandemic level in 2022. And especially demand from China is contributing to a strong rebound. Let's look at the balance sheet assets. Inventories are a major item on the balance sheet. SKF recognized a larger inventory in 2021 than they did in 2020. Inventory days have increased to 120 days in third quarter of 2021, which is a 20% increase to the previous year. Now, what about liabilities? The company did not significantly increase its long-term debt during the pandemic. They had good equity funding and good profits. Net debt to equity is likely to stay around 0.2 in the near future. Not much leverage. There's been a record margin in 2021, and 2022 is expected due to strong demand from industrial sector, where SKF makes a higher margin than from its automobile clients. So the net profit margin, I expect to be up at about 9%. That's already very, very good. So increased working capital requirements are lengthening the cash conversion cycle. Cash conversion cycle used to be 78 days. Then it was up to 85 in 2020. And I expect 86 in 2021 and 91 in 2022. Bottlenecks in logistics and customer shutdowns have increased inventories. Let's talk about valuation. Before we do that, I want to introduce the A Stotz Investment Research Stock Picking Checklist. It's inspired by Peter Lynch, one of the first books that I read, and he talked about 10 baggers. Those are shares that have the potential to go up by 10 times. It's based upon extensive research that we've done of companies that have gone up by 10 times. It's 9 factors that drive long-term share price performance. So let's look at it. The first factor is management. Management has a proven commitment to growth. I would say if we judge it on good, moderate, weak, I would say weak. There's no aggressive expansion or M&A plan from what we can see. Now, growth. The product and industry can support a decade of 10% plus annual growth. I'd say moderate. Industry could see high single-digit growth. Plus 10% may be hard, but I'd say moderate. Sustainable. Competitive strategy creates a sustainable high gross profit margin. Well, it's the second highest and most stable margin relative to the largest players in the market. So that's good. Quality. Good earnings quality. Non-core items are small or non-existent. I'll give it a moderate because there's stable operating profit, but extraordinary expenses drive down profit in 2019 and 2020. Efficiency. In the long run, we want sales to grow faster than or in line with assets, and it's moderate potential. Sales are likely to grow in line with assets. If we can see a company where the amount of revenue that they're generating from the assets they have in place is starting to rise, then that's a very good sign. But I would say it's moderate here. Tight is the next one. It's relatively low cash conversion cycle. Negative is best. That's what we would prefer. But the cash conversion cycle here is 85 days in 2020 and could see an increase due to higher inventory. So that's weak potential. Then there's cash flow. Operating cash flow is consistently positive. Good. That's stable cash flow generation in the past, and there's no reason to assume differently for the future. Capacity. Net debt to equity. This means that the company has the access to capital to grow. Net debt to equity stood at about 0.2 times in 2020. So if the company really wanted to grow, then they would be in a great shape to do it. Inexpensive. We like where the valuation is reasonable and avoiding very expensive stocks. PE on both, it's cheap on both PE and price to book compared to Swedish industrials. And here we go with key free cash flow. We can see that it's likely to have a negative free cash flow in 2021 due to an increase in inventory. But I'm not so worried about an increase in inventory for this company because they do have a very strong financial position. So maybe that increase in inventory had to do with something else. In fact, I want to tell you a story about inventory and about cash. Many years ago, we had protests here in Thailand, and in my business, Coffee Works, we saw that one of our hotel customers that we supply coffee to was seeing its occupancy go from maybe 80% down to 5% because nobody wanted to stay there because there was a protest going on. And so we decided that we would discount the coffee that we were selling them by 50% just for the period of time until they got their occupancy starting to rise again. Now, how could we do this? We did this because we had inventory on our hand, number one, and we had cash. We were not desperate for that. And as a result, we had a strategy that we could employ. And so one thing to look for is companies that are taking advantage of the current situation. Maybe they're growing their inventory because they're helping their customer, but they may be actually even earning more on the other end on their gross profit. So let's go back to what we're talking about this company, and let's look at the value estimates. So the consensus is about 6.1% revenue growth. I'm going to say about 6.7 over the next 3 years. I'm going to assume a little bit higher gross margin and net margin. And I've got a cost of equity of about 8% and a WACC of 6.8 and a terminal growth rate of 2%. I'm a bit more optimistic about the growth outlook. SKF should benefit from strong global demand for bearings over the next 5 years. We have a pretty big recovery that's going on. I look at the free cash flow of the firm method, and what do I come up with? The base case is Swedish kronor 265. That's a 20% upside. The bull case is 284, which is an upside of 29%. And the bear case is still an upside at 13%. So based upon that, I would say the company looks pretty good. Let's look at the world-class benchmarking scorecard. We identify a company's competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth. The scale is from 1 best to 10 worst. Here we can see, comparing this company relative to 1,480 large industrial companies, this company is ranked number 3. That's getting pretty good. Number 2 would be getting close to world-class, and number 1 is definitely world-class. Where is this coming from? Equally from profitability and equally from growth, which both are ranked 3, which is above average growth relative to 1,480 large industrial companies worldwide. So what are the risks? Well, market could become more fragmented with rising local manufacturers. That's always a threat. Failure to adapt to changing product requirements by customers and fluctuating input prices and inflation could pressure margins. So the conclusions. The sector leading margin results in ongoing value creation. Yes, it's an excellent ROIC. An industry faces good and stable growth prospects, and valuation appears cheap and could be a good buying opportunity. So I ask you, does SKF's high value creation deserve a re-rating? That's the question of this Friday night. This is Andrew Stotz from the Valuation Master Class. Have a great weekend ahead.